Raspberry Pi shares closed at a record high on Friday, up more than 233% year-to-date, after the company upgraded its full-year profit guidance on the back of surging demand it directly attributed to AI deployments at the edge. The FTSE 100 finished essentially flat, up just 0.07%, while the broader technology sell-off that hit chip stocks in New York weighed on sentiment across European markets. Against that backdrop, a UK-listed maker of single-board computers priced at £60, hitting a record is not the story the session was supposed to tell. The day's context matters. JP Morgan published a thematic note identifying stocks most insulated from AI disintermediation, names with proprietary workflows and embedded integrations that automation cannot easily replicate. Raspberry Pi was not in that basket. It was not supposed to need to be. It sells hardware, not software subscriptions, and its moat has historically been community and price, not IP. Yet the upgrade landed, and the share price moved to a valuation approaching £2 billion. Somewhere between the £60 board and the £2 billion market cap, a premise entered the pricing that the company's own product description does not fully justify. The Bank of England's Decision Maker Panel survey, released during the session, showed UK firms expect consumer prices to rise 3.7% in the year ahead, a reading that reinforced Berenberg's view that the central bank will resume cuts by year-end rather than hike. That macro frame kept gilts and sterling broadly stable, and Halifax confirmed that UK house prices fell 0.1% month-over-month in May, the third consecutive monthly decline, a signal that rate-sensitive domestic demand remains under pressure. None of that touched Raspberry Pi. The stock traded on its own logic, which is precisely where the question lives.
The profit upgrade Raspberry Pi issued is real. First-half performance came in ahead of expectations, and the company explicitly cited AI as the driver, not consumer hobbyist demand, not the education market that originally defined it, but enterprise and industrial deployments, where its low-cost, low-power compute sits at the network edge, processing data locally before it reaches the cloud. That is a genuine shift in the addressable market, and the stock is pricing it as structural rather than cyclical. The unstated premise the market is now treating as given, that AI's build-out phase will continue to require massive quantities of cheap, programmable edge hardware, and that Raspberry Pi, by virtue of its established ecosystem and developer loyalty, occupies a defensible position on that supply chain. If that premise holds, then the current valuation is paying for a transition from hobby hardware to industrial compute infrastructure. The question the market has not yet resolved is whether that transition is already captured in the upgrade, or whether it represents only the first increment of a much larger repricing. Here is where the logic becomes unstable. Raspberry Pi's AI demand is real, but the company's margins on hardware are structurally thin. The profit upgrade was driven by volume, not by a change in pricing power. And the Register reported that Raspberry Pi's DRM deal has risen alongside its revenue. The cost of memory components is consuming a meaningful portion of the AI demand tailwind. A business that grows revenue by selling more units at similar margins, while input costs rise with the same demand that is driving the revenue, is not compounding its economics the way a software platform would. The market is pricing it closer to the latter. The support signal from the SpaceX IPO dynamics is worth noting as context. In the US, tens of thousands of UK retail investors signed up for SpaceX allocations, a structurally loss-making company valued at $1.75 trillion, while institutional investors, including major pension funds, publicly declined on valuation and governance grounds. That divergence is not random. It reflects a broader participant split in how AI-era premiums are being priced. Retail capital is moving on narrative velocity, institutional capital is applying earnings screen discipline. The same split is visible in Raspberry Pi. The stock's 233% year-to-date move has outrun any upgrade to the underlying earnings model that the disclosed numbers support.
The verification point that matters is simple. Does Raspberry Pi's next set of results show margin expansion alongside volume growth? Or does the DRAM bill and component cost pressure keep profitability flat, even as revenue rises? A record share price built on a volume upgrade rather than a margin upgrade is pricing a second step that has not yet occurred. The historical parallel that applies here is not a perfect match, but is structurally relevant.
When ARM Holdings went public in September 2023 at a valuation that priced in the full AI compute buildout, the stock initially surged and then oscillated sharply as successive earnings reports showed that royalty growth, while real, was pacing below the TAM the market had priced. ARM eventually re-rated upward, but only after several quarters of reported results aligned the narrative with the numbers. Raspberry Pi's situation is different in that it is a hardware manufacturer rather than an IP licensor, which means its margin structure is harder to reframe without a genuine product mix shift toward higher margin software or services. The continuation case. AI edge compute deployments continue to accelerate through industrial and enterprise channels in the second half of 2026. Raspberry Pi's guidance upgrades again at the full-year report, and the stock's premium begins to look earned against reported earnings rather than anticipated ones. The breakdown case. Component costs, particularly DRAM, rise faster than volume growth in the second half. Margins compress rather than expand, and the full-year result lands below the market's implied earnings trajectory. At that point, a stock trading near £2 billion against a hardware business with thin margins has no fundamental floor that the narrative alone can hold. The leaning is toward a period of consolidation rather than further acceleration, not because the AI demand signal is false, but because the market is pricing a margin story that the company has not yet delivered. The participant structure tells you something. The 233% move happened largely before institutional capital had repriced the stock on the back of disclosed results. If the next earnings report shows volume growth without margin improvement, the gap between how retail and institutional capital have valued this upgrade will close, and the direction of that close is not the direction the record high implies. What would prove that lean wrong is not the next upgrade to guidance, but the next upgrade in gross margin percentage. That number, not revenue, not volume, is the observable that the current valuation requires to be moving in the right direction. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.